Hey everyone, Bryan Miller here, your trusted local mortgage lender, serving our communities all across North Mississippi. One of the biggest hurdles in a homebuyer's mind is the credit score. It's a topic surrounded by myths and anxiety, and I get questions about it every single day. What's the real number you need? How much does it actually matter? Today, we are going to do a deep dive into credit scores for a conventional loan in 2025. My goal is to demystify this process for you, because understanding how lenders view your credit is the key to unlocking the best possible deal on your future home. This knowledge can literally save you thousands of dollars, so let's get into it. Let's start with the baseline number you've probably heard, 620. For a conventional loan, a 620 FICO score is the standard minimum requirement. It's important to know this isn't a number I just picked out of the air. This guideline is set by Fannie Mae and Freddie Mac, the government-sponsored enterprises that purchase the vast majority of conventional loans from lenders like me. By setting these standards, they create stability in the national housing market. So think of 620 as the ticket you need just to enter the stadium. It gets you in the gate, but it doesn't say anything about where you'll be sitting, and the quality of your seat makes all the difference. Your journey from getting simply approved to getting a fantastic affordable loan begins right here. From a lender's perspective, your credit score is the foundation of our risk assessment. We use a system called risk-based pricing, which works a lot like car insurance. A driver with a perfect record pays a lower premium than a driver with multiple accidents, right? Mortgages work the same way. A higher credit score demonstrates a history of responsible financial behavior, making you a lower risk in our eyes. A lower score suggests there have been some bumps in the road, which increases the perceived risk. That risk is then priced into the loan terms we can offer you. This is why two different borrowers applying for the same loan amount on the same house here in North Mississippi can receive two very different interest rate offers. It all comes back to the story your credit history tells. This is where we move beyond the minimum and talk about credit tiers, because this is where you can see the direct financial impact of your score. If your score is in the 620 to 679 range, you're in what I'd call the approval with conditions tier. While you meet the minimum guideline, you will face higher interest rates. Lenders may also impose what we call overlays, which are stricter rules on top of the base guidelines. For instance, we might require a lower debt-to-income ratio or a larger down payment to offset the risk associated with the credit score. Furthermore, your private mortgage insurance, or PMI, will be at its absolute highest cost in this tier. This can add a significant amount to your monthly payment, directly impacting your affordability. The next step up, and a crucial target for many buyers, is the 680 to 739 range. Landing in this good credit tier is a game changer. Suddenly, you're seen as a much more reliable borrower. The lender overlays often disappear, you'll have access to more competitive interest rates, and your PMI costs will drop dramatically. For many families I work with in DeSoto and Marshall counties, moving from a 670 score to a 685 score has been the final push they needed to make their desired home truly affordable. It demonstrates to us that any past credit issues are firmly in the past and that you are on solid financial footing. This range is where the path to homeownership becomes much smoother and more financially sound. The top tier, the goal for everyone looking for the best deal, is a FICO score of 740 or higher. This is the excellent credit range. With a 740 plus score, you are a prime borrower, and lenders will compete for your business. You will be offered the lowest possible interest rates and the most favorable loan programs available. Your PMI costs will be at their absolute minimum. The financial difference between a 640 score and a 740 score is staggering. Over the life of a 30-year loan, we're not talking about saving hundreds of dollars. We're talking about saving tens of thousands. This is why I always advise clients to start working on their credit 6 months to a year before they plan to buy. The effort you put in upfront pays massive dividends on the back end. Now, it's critical to understand that the score itself is just a summary. The real information is in the credit report itself, and as an underwriter, I can tell you we read it like a book. The single most important chapter is your payment history, which makes up about 35% of your score. A consistent record of on-time payments is vital. The next largest factor, at 30% of your score, is credit utilization. This is the ratio of your credit card balances to your total credit limits. If you have $10,000 in credit limits, you want to owe less than $3,000. Maxed out cards are a major red flag, even if you're making the payments, because it suggests you are over-reliant on credit. The length of your credit history, your credit mix, meaning a healthy combination of installment loans and revolving credit and recent credit inquiries make up the rest of the score. A clean, well-managed report is our clearest indicator of a responsible homeowner. Even with a perfect score, your application relies on two other pillars: capacity and collateral. Capacity is your documented ability to repay the loan. We measure this primarily with your debt-to-income ratio, DTI, which compares your proposed monthly housing payment plus all your other monthly debt payments against your gross monthly income. For most conventional loans, we look for a DTI of 43% or lower. We also verify your cash reserves, the money you have for the down payment, all closing costs, and typically a few months of mortgage payments left over in the bank. This shows us you have a safety net and aren't draining your accounts just to get into the house. Collateral, of course, is the property itself. The home must undergo an appraisal to ensure its market value is at least equal to the sales price. This protects you from overpaying and protects the lender's investment. If an appraisal comes in low, it becomes a point of negotiation. You can try to get the seller to lower the price, you can bring extra cash to the closing to cover the gap, or if you have an appraisal contingency in your contract, you can walk away from the deal. It's another critical step where having an experienced team on your side is invaluable. So, what can you do right now to prepare? Start by paying every bill on time, lower your credit card balances to below 30% utilization, don't close old credit accounts as their age helps your score, and please do not make any major purchases or apply for new credit before or during the mortgage process. The absolute best first step is to get a full verified pre-approval. This is different from a quick online pre-qualification. A pre-approval means we have pulled your credit, analyzed your income and assets, and can tell you with confidence what you can afford. It makes you a powerful, serious buyer in the eyes of a seller. Here in North Mississippi, from South Haven and Olive Branch down to Tupelo and beyond, my team and I help people navigate this complex process every single day. We can give you a personalized analysis of your credit and create a clear, actionable plan to get you ready for home ownership. If you're ready to see where you stand and want a trusted partner to guide you, I'm here to support you every step of the way. Be sure to like this video, subscribe to my channel for more in-depth mortgage advice, and leave any questions or comments you have below. Thanks for watching, and I'll see you in the next video.